Hey everyone, welcome to the Everyday Investor. Our first shot at this is actually kind of exciting. My name is Greg Jensen. I'm the CEO and founder of OptionsANIMal. Pleasure to be here with my friend and compatriot, Mr. Hale. Eric, I'll let you introduce yourself.
Sure. I'm the founder of Trader Oasis. I'm also a partner with Greg at OptionsANIMal. So Trader Oasis is a place for people to trade. OptionsANIMal is a place for people to learn.
So our thoughts around this new podcast that we're doing, Everyday Trader, is we just want to talk. We just want to talk about what we're doing, what we see in the market, maybe what we see in life. Maybe not will always be about the market. Sometimes it might be about a bike ride. You got a bike ride coming up, yeah?
Yeah. So Saturday, I'm heading out to Iowa to do the 49th annual RAGBRAI, which is the Des Moines Registers, a newspaper, started this thing 49 years ago with a bunch of guys just getting on their bikes and riding across the state. So now it's a pretty big thing. Up to 15,000 people do it. And we leave. I'm going to leave here tomorrow morning, Saturday morning, and then I'll hit the road Sunday and hopefully be back here Sunday night. Not going to ride my bike to here because Iowa is about 4 hours from where my house is in Illinois. But yeah, that's my big plan for next week.
Awesome.
And everybody thinks that Iowa's flat. It's flat like a waffle. So Illinois is flat, right? So I live in Illinois. They call us flatlanders, but Wisconsin is hilly, but Iowa, believe it or not, is actually fairly hilly. So I saw a T-shirt that said "flat like a waffle."
I drove across Iowa once. All I remember was corn.
So, yes, corn and soybeans. That's all I remember. Those farmers corn out there. Same thing here in Illinois. So
it's kind of like where I'm from. People Idaho, it's potatoes, right? Well, you actually were in Idaho with me last week. In fact, that's kind of what we wanted to talk about today. We had the opportunity together we attended the Rocky Mountain Economic Summit that was held in Victor, Idaho, which is just outside of Jackson Hole, just across the border from Jackson, Wyoming. And there were a couple of representatives from the Federal Reserve there. We had economics professors. We had partners in multi-hundred-billion-dollar hedge funds who were there. We had financial advisors for Morgan Stanley and Wells Fargo. Anyway, interesting conversations that we had last week in regards to the economy, both the state of the big macro economy. We talked about some micro things. We talked about the markets and how they're related to the economy. We talked about politics a little bit. And so it was a enlightening few days that we got to spend together. And I thought what we should do today is kind of go over our views as to what we took away from the conference that we attended. So I don't know where you want to start. You want to jump straight to Fed Governor Waller?
Yeah, that's a good place to start. So Greg mentioned that this event, which is very well attended, for those of you that were paying attention to last week about the Federal Reserve, we got inflation data last week that came in that was shockingly 9.1% on the CPI. That happened while the event was going on, and there's, as Greg mentioned, a lot of people from government, from the Federal Reserve, from businesses that attend this thing. And a good portion of the meeting runs under what's known as Chatham House rules. So Chatham House is a place in the UK where economists and policymakers and business leaders can get together and sort of take their hats off, let their hair down, and just talk to one another. The understanding, when you might have heard Chatham House rules before, as opposed to Cider House rules. Was it Cider House, that TV show that was?
Yeah, Cider House rules.
Okay, so Cider House Rules is a TV show, but Chatham House rules is where people got together in the UK. It still exists, actually, where policymakers and economists can talk and business leaders, and you can really kind of say what's on your mind without having to guess. So portions of this conference, which it's public, is who was there. In fact, if you watch Bloomberg, you saw. We mentioned that the CPI announcement, the 9.1 CPI rate last week was there. And one of the speakers was Christopher Waller, who's a governor. He was a former vice president of research at the St. Louis Fed. He's got a very long and prestigious career. He's an economist, economics professor, worked at several major universities, but he was there, and Greg and I got to spend some time with not only with him, but some other people. Greg and I actually got some one-on-one time with Governor Waller to talk through he was the headliner, probably the most important person that was there. We can share some anecdotes, but Greg, what were your thoughts about not only Waller's speech, but some of maybe we should talk about his speech. And then we could talk about some of our one-on-one time.
I would say his
with
biggest
him.
message that I took away from his speech is that the Fed's not going to pivot this time like they did in 2018. And their goal of battling inflation, they have to stick to their guns. He referenced back to Chairman Volcker back from the 70s and how they ended up taking interest rates a lot higher than they had planned on doing at the time, but they had to stick to their guns to battle inflation, and they see the same problem right now at the FOMC. I mean, he said that the FOMC has to be focused on drawing down inflation back to their 2% target, even if that means, and he references several times throughout the conference, even if that means another 20% drawdown in markets or even a 25% drop in the value of homes. I remember him saying a reference of, our homes in general across the U.S. right now have gone up 45% in value in the last 2 years. And I know some homes in some areas have gone up much more than that. And he said if what we're doing at the Fed with interest rates causes home prices to correct 25% in the next 2 to 3 years, well, you're still up 20% on your home in a 4 to 5 year period, which is a good investment. And so I think he was trying to bring people back in to reasonable expectations and kind of setting the stage that the Fed's going to step on the brakes right now pretty hard.
Yeah, he made that pretty clear. And he also threw out the other anecdote that if you went back to 2017, the Dow Jones Industrial Average was at 15,000 or 16,000, and we're now at 30. People tend to measure their value from their high watermarks, like what was the most your house was ever valued, or maybe the highest of your portfolio, and anything that's dropped down from that is a loss. But if you look at a long-term chart, certainly things don't look that bad. Waller was he was pretty clear on that, and you hit what I would say is the key takeaway from my perspective, in that the Fed is single-minded, single mission focus on getting inflation down. And he specifically talked about some of the mistakes that have been made in the past. First of all, we can argue whether or not the Fed acted soon enough. I think the general consensus, and they'd probably agree too, they probably should have acted sooner, but they're committed now. And right now it's kind of a paradox because we see jobless numbers. So unemployment numbers are fantastic. I mean, we're near full-time employment. There's 2 open jobs for every person looking. Some places it's higher than that. So we've never had a recession with unemployment below 5%, I think is the quote that he made. So whether or not we're going to see a recession or not, and the point here is that the focus isn't going to be on jobs. And there will be some leading indicators, and we're already seeing leading indicators that could affect the job markets. People are concerned about, Apple's going to slow down their hiring. It's like that's not laying people off. That's just slowing down hiring, because the first place you're going to see it is in the want ads. So companies are going to stop placing want ads. The other anecdote I wanted to share, I thought you were going to go there with this, is he was talking about Volcker, and that he had a chance to meet with Volcker and said, well, gee, that was very, very courageous of you to start raising rates and to push into the double digit inflation and everything that happened back in the 70s. And he said, of course, if I'd known that was going to happen. Yeah. So we're working through some technical issues here, which is expected on our first one. But in the speech, which by the way, I think is available online because Waller was streamed on Bloomberg. But he talked about meeting Volcker and talking about the courage to be able to raise rates in the face of such inflation and pushing the economy into recession. And Volcker said, of course, if I'd have known that it was happening, I wouldn't have done it. So, but once you start down that path, and that's the point that Greg just made, is that the Fed is committed to going down this path to get inflation under control. And while it wasn't explicitly said, I think in the words in between that we're probably likely to see it in the labor market. And Volcker himself actually, I think, came out and said that we probably need to see inflation at 5%. I'm sorry, unemployment.
Unemployment.
Yeah, at 5% or higher in order to get inflation down. So that was one of the interesting topics there.
Yeah, I will throw out that he said that the nightmare scenario that exists out there for central bankers is if they do this tightening trying to control inflation that we know is not all demand driven. A lot of it is. Some of it's supply chain driven. Some of it's coming in the back end of COVID and the restrictions that have happened there. But if they go raise rates right now to try to combat this, and they do push unemployment to 6 to 8%, and then still have 6 to 8% inflation, and they can't control the inflation, that he said that's the nightmare scenario that keeps him up at night. And so, not that he expected it, but that was like his worst case scenario that could happen from all this. I think I was optimistic about his future view of the economy, that we've got some challenges in the short term, inflation being the biggest one, but the labor market's strong. The amount of liquidity in the system is still huge, and so it's the right thing to do right now, is raise rates.
Yeah,
okay,
I think that's clear.
What else? Do you want to share anything else about Waller? I mean, what else? Conversations with him? You want to move on to Paul Ryan?
We can't really share. We had some one-on-one, so probably Chatham House rules. Although he did say he hasn't said anything in the forum, the private forums that we had. But Greg and I had the opportunity to sit down with him after dinner, and then actually have dinner with him, and then see him at lunch and things. I was going to show you that. Let me show a picture real quick of this. I don't have how beautiful the stage is, but I'll show from our seats where we're sitting. Let me share the screen here real quick. So this is Waller when he's giving his speech, and then here he is with this is the camera actually was broadcasting. Here's Mike McKee, who was asking questions, and so there's a good Q&A. But I was going to show what Waller did. Here's Waller later. He went up and you can see in the background here, some of the people are pretty casual. So he changed into something much more casual. Here's also Paul McCulley, who was also there, who had some interesting words. But yeah, I just wanted to share those photos there. Real quick. I got to share one more while we're still talking. We'll probably talk more about this, but the food here was fantastic. These are the tomahawk ribeyes that we had one night. Here's the charcuterie board when we got there. Pretty good time. Good food, good people, really great views out there, and on the other side of the Tetons, which you're fortunate enough to live out that area and be able to see that out your backyard.
I can. Yeah, for me, it's just a short drive. So yeah, it's fun that conference gets held every year out here.
Next was Paul Ryan. Do we want to share?
Yeah, I was just gonna. Yeah, let's talk about Paul just a little bit. Let me move my nose to Paul. The only thing I was going to add maybe about the Fed is, like you said before, most of that stuff is out there. I would say meeting Christopher Waller personally gave me actually a lot of hope. He's a pretty sharp guy. Of all the Fed governors I have met at these conferences over the year, I'm going to have to chalk him up as number one. That's my favorite one I've met so far.
Yeah,
So
yeah. He's very reasonable and realistic. I'll tell you, I came away with a lot more hope too, because I hear some stuff sometimes that different members of the different governors and presidents of the regional banks talk about, and sometimes it makes you twist your head. And he talked about central bank digital currency, which he's been on the record talking about that as well, and he's really not in support of it. I think that's pretty interesting. His argument, of course, is that what does the central bank digital currency solve? What problem does it solve that is something we should solve? His point he made was it's essentially a checking account. And why do we want to compete? Why does the Fed want to compete with existing banks that have checking accounts? I think part of some of the advocates for central bank digital currency is the ability to direct where money gets spent and not passing a judgment as to whether or not that's a good thing or a bad thing. I think his point is that should the Fed be doing that? If there's, is there a vehicle? Is there a better vehicle other than a central bank digital currency to get money to where it needs to go? And this sort of dovetails into what Ryan talked about. Paul Ryan talked about the lack of good regulations. And so this is former Speaker of the House, Governor Ryan from Wisconsin, was there with his family. The second time that we've had a chance to spend time with him. He's really down to earth, good guy, really reasonable and sees both sides. And I think he's pretty pragmatic. But he went on about how Congress really hasn't been doing a good job, and that they're putting a lot of they pass a regulation, and the regulation ends up getting interpreted by commissions. And one of the examples is the EPA, the West Virginia Supreme Court ruling that just happened here, which could be an indication of signs to come. That I think the point he makes is that Congress hasn't really done a great job of doing its job, and it's relying on other entities like the Fed or the EPA or other SEC, other commissions to take the laws that have been passed and interpret them. What else did you take away from?
Well, to quote, I'm not going to quote him directly, but something I wrote down that was a thought that he said is that really there is no clear path to the fiscal side of this equation getting its act together anytime soon. I mean, they are in political gridlock right now in DC, and the fiscal issues that are going on are real. He shared, based on the CBO, that the expectation of bankruptcy for Medicare is 2028.
Yeah.
And
Social Security 2035.
2035. Yeah, those are 2028. I'm like, that's only 6 years away. Yeah. If we don't have some major policy changes right now on the fiscal nature, we are going in the exact opposite direction, the exact wrong direction. The last thing we should be doing right now is taxing prosperity. So one of the things I like about former Speaker Ryan, is that he views things both short term and then looks at things from a medium to long term type of situation. And you referenced his West Virginia Supreme Court ruling as kind of a short term, maybe one of the biggest things that's going on right now, and that may help eliminate some of this excess regulations. He referenced back to the Volcker era when we were dealing with inflation, and he said, Jimmy Carter didn't get a lot of credit back then, but he actually probably should have, for helping eliminate a lot of the regulations that were also causing some of the inflation problems, causing some of the lack of productivity. And that if we can do that as a country right now and eliminate some of these regulations, that's a good short-term trend that we should be on, or should be seeking to be on anyway. And then of course, medium to long term, we have those issues of our outstanding liabilities, our the social contract that we have with our society right now, that social contract, of course, being Medicare, Medicaid, Social Security. Do we have the type of cushion right now in our system to absorb any more shocks? Was another question he brought up. So
yeah, The
Yeah, go ahead.
social safety net, the social contract. He mentioned that a couple of times, and he also expressed something else that I think we're all feeling here. At least, I think the vast majority of people in America. He talked about, and I've used this several times, and I know some of the you hear John Sylvia bring this up later, but he talks about that we have various wings of the party, and he introduced a new category, the entertainment wing of the Republican Party, and the entertainment wing of the entertainment wing of the Democratic Party. That there's people that are out there that are talking about extreme views and trying to get people's attention by either getting clicks or getting on the media. I think that's something we all feel right now. And he made a comment, can we get the politics right in order to address these big problems? And certainly a question that I think we all have right now. And I don't know the answer. We don't want to go too far down the politics angle of things here, but it is important because it absolutely affects markets. And this is a big year. It's a mid-cycle year. We've got election coming up in November. That's going to have significant impact. And again, this is not about, the red team or the blue team, whichever side you vote for it, but it is going to have an impact on the markets. And we're expecting more volatility. This wasn't discussed at the conference, but you can look at historical years going back at every time there's a mid-cycle year, we tend to have a very rough year that gets, and by the way, the volatility is probably not done, even though it's been bullish lately. We tend to get a pullback that happens in October. And then November, we tend to be much higher. So I expect we're going to see that. The VIX, if you take a look at the VIX futures and other sentimental indicators, it's saying the same thing. Yeah, we're going to see more volatility is going to continue, but we need to get the politics right in order to be able to move off of move forward on some of these very important issues that are coming up pretty quickly.
And just to put it into perspective, Paul Ryan. I think one of the reasons he was even invited to this conference isn't just because he was a politician. I imagine if, Nancy Pelosi doesn't have the similar background as he does, he's specifically qualified to speak to the broader economy. And that's, I think, both because his background, even inside of when he was serving in government, when he was serving on Capitol Hill, was in the the Joint Economic Committee, and he wrote budgets for the Congressional Budget Office before he became a speaker. And now, after he has left the public realm and has gone back to teaching, he's a professor at Notre Dame, and he's not a professor of political science. He's a professor of economics. That's what his study is. So he actually really was well spoken, and I thought added to the conference, but because he was still giving us his political insights and lending it to the discussion about how does this impact the economy. And I'll be honest, my takeaway from him was a little unnerving. I was worried after hearing from him.
Yeah, I think about the year before where he nailed it. I mean, last year he nailed. The reconciliation bill. He talked about how important the Build Back Better bill was going to be. He nailed out, exactly how the cards were going to lay out, and he played it out pretty well. And so this year, I don't think he was quite as explicit in laying out the same plans, but I did come away being a little bit more depressed, from what I heard from him.
Well, and the next panel didn't really add much to fix that either, right? Because the next panel we had our economic outlook panel, and it was made up of John Sylvia, who is the former chief economist for Wells Fargo. He's currently, let me actually pull up his.
He used to be on the Senate Banking Committee back in the day. So he was one of two people who read the Fed releases 24 hours before they came out, because his job would be to receive the Fed announcement 24 hours before it was sent out. And he would have to update and tell staffers what it was so that senators could be prepared. He's got some pretty good stories to talk about with that.
His current company's name is called Dynamic Economic Strategy. He launched that a few years back after he stepped away from Wells Fargo. But he's been in the business for a long time. If there's someone who nailed the forecast last year, it was him.
He's an econometrician, and I have a couple of his books. So this one is his latest book, Modeling for Effective Decision Making, and this one's a classic that's been around for a while. So John's a really smart guy, one of the best, and very, very again another person who's very pragmatic. Let's just say that he marches to the beat of his own drum, which I think is great because we get so much echo chamber stuff out there to be able to. John does his own independent analysis and makes his own conclusions, which didn't agree with Waller, right? I mean,
no. And in fact, he was one of the only people at the conference this last week to come out and say, we're not going to be in a recession. We're in a recession. And, if the public starts to believe that we're going to use inflation to pay off our national debt, then we're going to have a problem. And that's, I think, one of the main reasons why he was very in favor of what the Federal Reserve is doing to try to control inflation. He doesn't think it's permanent, but it's here and it's real. It's not transitory.
I had stagflation written in my notes a few different places, and here's another one that threw out the term stagflation. Do you want to share what stagflation is for people, just so they understand the term?
Yeah, stagflation from a definition standpoint is where you have a declining economy. So you're technically in recession from a GDP standpoint, but at the same time, you have inflationary pressure. So prices are going up. So it's like a double whammy. Not only do you have slowing economic growth, you also have increasing prices at the same time, which is the worst scenario from an economic standpoint outside of a depression. So I noticed that as well. And John's a pretty upbeat guy. He still wanted to look forward. I'm trying to remember now. You even asked it before we started, Eric. What's the term that he used? That was named after the Navy pilot who was the
paradox. Shoot. I was just looking for it. Well, he sent a newsletter.
There it is, Stockdale. The Stockdale paradox. And that Stockdale paradox is based on, again, they named it after a former Navy pilot who was taken prisoner of war during Vietnam. He was able to get through his ordeal and being a POW with this paradox that again has been named after him. That is, you have to be able to look forward and think, I'm going to conquer this. We're going to come out victorious eventually, but still not be blind to the reality of the bad news you're dealing with as well. That's the Stockdale paradox. And so right now, that's what John Sylvia referenced we are in this economy. There's reason to look forward and be excited and have a hopeful future. But at the same time, you can't blindly say, we're not in a recession, or inflation is transitory, or inflation is all Putin's fault. It's here, and we have to deal with our bad news.
So other people on that panel, one of the highlights, of course, was Holly Wade. She's the executive director of the NFIB, National Federation of Independent Businesses, and they do a pulse survey they do multiple surveys of small businesses, and she painted what I would characterize as sort of a negative sentiment among small businesses, and you can see the NFIB index, and if you take a look at the chart, and it is expressing what I think what a lot of people are feeling. And they're having a hard time hiring people. They're forced with rising in prices, but they're not passing the prices on to people yet. What I took away, correct me if you didn't get the same message, but what I heard her say was that they're absorbing the cost because their fear is that the competitors won't. So to stay competitive, so they're faced with kind of a bit small business faced with a bit of a perfect storm, and that they've got inflation going up, so their costs are going up. They've got wages, pressure on wages. They're having a hard time hiring people, and they're feeling like they can't pass those prices along, at least from the small business standpoint. Did you?
Yeah.
Same thing or anything to add?
No, she was, I've read NFIB stuff for a while, and she was very pessimistic. Most small business owners are are uncertain, and that's the one thing they need, is they need some level of clarity. They need some level of certainty on something, and there's so many different factors impacting small businesses right now, and it's causing confidence to be lower right now, even though, again, the economy's flushed with cash, and a lot of these small businesses are still doing, from a profit and loss standpoint, doing okay. It's trying to look into the future and forecast whether that's going to be the same, even just 6 months down the road, is very difficult for businesses right now, especially for a smaller business that doesn't have, pricing power like a Walmart or a Target might have in delivering their products. The last guy on the panel, very interesting gentleman that we met, Leland Miller. He owns a company called the China Beige Book and has done an enormous amount of research, obviously, about China over the last decade in building this company, and arguably to the point where China actually pays attention to him. The government will make sure that he's telling the truth in one sense.
Well, the Chinese government isn't one of his customers, but as he knows, pretty much anything that has the word China in it, somebody in China probably already has a copy of it, even if it's hidden, encrypted, and on the bottom of your, hard drive. That we all know that China is looking at it. So, yeah, he does this. So the Beige Book is something that's done in the United States. It looks at different regional economic performance, and his business was created. I don't want to put words in his mouth, but there's a lack of clarity on data, and so there's a need to get independent data, and so he is doing the independent surveys, taking a look at different regions in China.
So one thing I took away from him in his presentation about China is that, and he admittedly said, China is a mess right now. It's mostly due to the country's handling of COVID lockdowns and trying to enforce a zero COVID policy. And he doesn't think it's over. He said, but if China bounces back, if we get a China bounce back story in the second half of this year, because we do get past the lockdowns that have been happening over there, that could actually have a really big inflationary impact that could get imported into the United States. See, right now we're dealing with inflation with arguably getting deflationary pressures from the second largest economy in the world, in China. And if China turns it back on because they feel like they've controlled COVID, our inflationary pressures could actually tick up, because we would start to import some of those inflationary pressures from China as well.
Yeah, pretty interesting, especially with the strengthening dollar that we're seeing right now. By the way, did you see this tweet? I saw this tweet that said, now that the US dollar is past parity, so a dollar's worth more than a euro, somebody posted something to the effect of, it's now called soccer, get over it. So,
I did see that. That's right. We can now call it soccer.
Yeah, so you Europeans, it's no longer football because the US dollar is stronger. And it's not a joke. It's actually not a good thing for the US dollar to be too strong. I mean, we like the idea of being America being strong, but it hurts our businesses, and we're certainly going to hear about it coming up in earnings. I think Apple next week, I would expect them to bring up either concerns about inflation, or inflation will certainly get mentioned, but usually there's some comments about foreign exchange, and with the US dollar strengthening, that makes our products more expensive for people overseas. Yeah. I watch out for earnings next week on Apple. I wouldn't be surprised if we get a warning because of that.
Let's hope it's not like Snap's earnings today, right? Yeah. Down 30% today.
Well, it can happen, folks. You should keep. Oh shoot, like the UPS guy coming up. I guess
everyday trader.
When you work, every day home. I'm working from home. You all got your dogs are probably barking now too. Yeah. So, anyways, where was I going with that?
Well, we were talking about the strength of the dollar and how it's going to impact international companies. And it definitely will.
Oh, it's gonna. Yeah, I know what I was gonna think. Let's go back and look at April, or just go back earlier this year and look at what happened to Netflix. Look what happened to Facebook. I hope something like that doesn't happen to Apple. But for those of you that are out there doing cash secured puts, you might want to consider maybe not carrying those over earnings, or if you are going to do them, make sure that you know how to hedge yourself. Do you want to? Oh, there was one other person on that panel. I don't know if we're going to be completely thoroughly, but Holly Wade was on there. She's the chief economist for the conference board.
Not Holly Wade. She was the
Holly Wade. I'm
NFAB.
sorry.
Dana Peterson.
Yeah, Dana Peterson. I'm sorry. Holly Wade was NFIB. Dana Peterson is with the conference board. And I love the conference board. They do the leading indicators, which, by the way, came out yesterday. The LEI came out yesterday, 4 months in a row with a decline. When we see the LEI, which is a mix of a whole bunch of different indicators, and we have data going back to the 50s. If you line that up with recessions, when the LEI starts to roll off, well, let me say it the other way. Every time that we've had a recession, the LEI has rolled off, but the LEI has predicted, I think, 14 of the past recessions. So the LEI can roll over, and it's possible.
14 of the past 9.
14 of the last 9, exactly. Yeah. So the LEI is rolling over. So it's one of the sort of canaries in the coal mine that we're keeping an eye on here. But yeah, but Dana did a really good job moderating and provided some good insight that I think lined up with some of the comments we've already made.
Okay, couple more. Paul McCulley stood up next, and Paul is a character. I love Paul. I've known him for years now. He formerly ran PIMCO. Back when Bill Gross was running it, he was right side by side. He and Bill Gross are, two extremely good friends still. Paul now is a professor at Georgetown. He stood up and talked mostly about the idea that he thinks that we've absorbed things pretty well. He was as optimistic, to be honest, as I've seen him about the path forward. For the past 2.5 years, we've had this series of, this is where it was his words, of these rolling shocks to the economy. And
force majeure, act of God. I mean,
yeah.
So he teaches contracts, and he talked about how contracts are, how everything in economy, how capitalism works, and that we had COVID, which was a force majeure, an act of God. It's not because of hubris or malfeasance or incompetence. It was something beyond our control, and that happened, right?
Yeah, and if we, 2 years ago, when we're all sitting in the middle of lockdown of COVID, would have looked at ourselves and said 2 years later, the markets are doubled, our home prices have doubled, and we're dealing with 8%, 9% inflation, would we be happy? Absolutely, we'd be happy. Yeah. If that was, 2 years ago, we were hoping we weren't looking at, some type of, exactly.
Yeah, we thought it was the Great Depression again, that we were going to see, a decade lost. I know I was in that camp. I was I was definitely fearful. I just finished, by the way, I did finish, and I recommend it to you. I know what we talked about already, is Nick Timros's $1 Trillion Triage. And it's very timely. And there's actually a prologue that he updated some of the more recent stuff. It's pretty interesting because they're talking about the Fed trying to raise inflation. I mean, it was just a couple short years ago that we were, we've had a decade low inflation and couldn't figure out how to get it higher. And now it's hard to imagine now that was our problem for nearly a decade, that we couldn't get inflation up. And now we're all experiencing much higher inflation. But it's a good book. By the way, I'm sure you probably saw, did you see Bianco's tweet about?
No, I haven't seen anything from Bianco lately.
He says the new Fed policy is that there's a two-week blackout period where the Fed doesn't talk, which isn't true. Did Waller get 2 weeks or not? I'm not sure. Next week. So maybe he did get in within the 2 weeks. But then the chairman of the Federal Reserve, Nick Timros, leaks the answers to the world. So Nick is a writer for
Wall Street Journal, right?
And folks, he's somebody you should have on your watch list. Smart guy. I love that book. But the Fed, I guess that's another thing I'll take away from Waller. was that the Fed is making significant efforts to communicate clearly. This was not, I don't think this is confidential, but Waller told me that he and Jay went back and forth 7 times on the speech that he gave.
Yeah.
That Jay Powell and he talked 7 times about that speech, which says to me that I don't want to call Jay a micromanager. I don't think that's the situation. I don't think Jay Powell is. I think what that means is that it's very important that the language that is communicated to the market. In fact, Waller actually talked about what they're looking at in terms of responses for what they say and how it impacts the market. And I think that the good news for those of you listening here is that the Fed isn't going to surprise us with anything. It goes back to what we said earlier. The Fed is going to be very clear about communicating and what its intents are. I mean, there still is some Fed speak that you have to read between the lines, but it's one thing that gave me confidence. At least we're not going to see any significant, out of the blue changes. I mean, they're going way out of their way to communicate.
So the last panel, and I'm going to speed us up because, I don't want to take all day. And I promise all of our podcasts are not going to be this wonky. They might be because Eric and I have a tendency to get wonky a little bit. But we're talking about an economic conference we went to. We want to share some of these insights because this stuff does matter. The last panel was specifically focused on the markets. And the first individual who got up and spoke is a gentleman by the name of Don Rissmiller. He's the founding partner strategist. Basically, it's Strategus. I always say it wrong. They're basically a macroeconomic research firm. They do a lot of macro research for investment houses and provide a lot of content for people making investment decisions. And really, really bright guy.
And their clients are not like you or me. Their clients are people that are managing $500 million.
Yeah, their clients are some of the other people we met there.
Yeah, there are a bunch of their clients there. They're all names you've heard of. So
yeah, Guggenheim.
Did you say it out loud?
I did, but I didn't say anything that she told us there because that's in the other Chatham House rules. No, but Don talked a lot about productivity right now. And productivity numbers are bad right now, and that this it could be because number one, maybe the numbers are wrong. That's one possibility. It could be that we're just seeing a lag in productivity because of COVID and coming out. Comparable numbers are different. We're still trying to come out of the work from home scenario and going back into the workforce. And some companies are doing it, some companies are not. And so maybe it is also that we're seeing a shift right now, and a new paradigm, if you want to call it that, of productivity because of this work from home change that was kind of forced upon us from COVID. So right now it's the productivity model is indicating that the economy's in trouble right now, I would say. We're not being very productive, and the only way to really increase productivity is either increase technology and become more effective there, or to increase the workforce.
I'm laughing because the conversation we just had before this, you and me, about one of our favorite tweeters. So productivity is a measure of output or efficiency. So it's essentially a company's output divided by hours worked. So if you have people not working more, and there's an argument, one of the things that he brought up is, is there a productivity shift? Sort of the narrative is that work from home allows people to be more efficient, but not everybody's on the same page with that, right?
Right.
Did you say, I didn't see the tweet, but you said,
said, Elon. I'm trying to remember even the exact name
but it was something along the lines that
it was something along the lines that people who say their work at home are lying, or they're not. They're faking it.
I'll admit, working from home, there's some times where I might, go for a nice long walk or do something that's not necessarily work related. But I'm also working at 10 or 11 o'clock at night sometimes, as you know, because you get emails and you'll see things from me that'll happen at all hours of the day. But I know that not everybody's like that. So maybe that's an explanation. Is this a permanent change or not? But yeah, this productivity thing is something that Don's actually quite an expert in that area. He's written quite a bit about productivity. It's something to keep an eye on. And then of course when Elon's robots come out, productivity is going to, I don't know where productivity is going to be when we have the Optimus Prime out there, or what is it? Is it Optimus? I think he's calling it Optimus Subprime.
Yeah.
The robot that's doing that was an interesting thing. I saw you took a note on that. Who was talking about cobots? There was the second day there was an interesting discussion about cobots, which are robots.
I wasn't planning on talking the second day, so I don't have my notes from day 2. But yeah,
but you remember the conversation?
I do.
You pulled it up and you showed me. There's somebody who's talking about productivity enhancements that these not a fully replacement of a human, but something that can work next to a skilled worker and help them do things.
And yeah, what it does is it take this idea of cobots is it takes one worker that you don't have to train and turned into this skilled employee. Basically, all that worker is doing is babysitting the robot.
Oh, is that what it is? Okay.
To make sure the robot is actually doing its job correctly, which is also an inexpensive workers. So you're taking two inexpensive resources and being able to replace a very expensive resource in that very skilled and highly skilled employee. And so that's the idea of cobots, and probably the biggest risk to or maybe advancement, however you want to look at it, whether you have one of those jobs and you have the risk of being replaced by a robot, or whether we see that as a business owner standpoint or productivity standpoint. That can help us increase our productivity. One note that I and again, I don't even remember if it was Don that said this or this was a thought that came to my mind. I'm pretty sure Don said this, but I wrote down in my notes is one factor to look for that we've actually bottomed in the market is that we need to see long run inflation anchored. Before long run inflation gets anchored, doesn't mean it has to be down to 2% again, but it's got to stop, having this volatile whipsaw. And particularly in this case, we're just seeing it go straight up right now. The stock market will not bottom until long run inflation is anchored. And I thought that was an interesting note that, I know a lot of people sometimes say, well, you can be optimistic and you can still make money in the overall market when inflation is going higher, which I think you can on a sector specific basis. But the S&P as a whole, we will not have bottomed until we see long-run inflation anchored, which I don't think we see yet. Yeah,
I think you're right. I guess other things keep popping back into my head. And one was on the yield curve. We had a discussion with Waller about the yield curve as well too. I'd say that they're somewhat positive outlook on the market. If you look at the market pulling back, there's the argument that we're still up from where we were a few years ago. But from their perspective, if you look at the fundamentals of a company, when you look at fundamentals, one of the factors that goes into the future earnings of the company, looking past technical or sentimental charts, but just looking at what's a company worth, as capital increases, it takes away the value of the company. And his argument is, in November, we announced that we were going to start raising rates, which meant inflation was going to go up, which meant rates were going to go up. And isn't what we're seeing in the market just a fundamental repricing, recognizing a higher inflation rate? And that's a really reasonable argument to make. And then the other question, so people are talking about the yield curve inversion, and is that a concern? Because we see the yield curve invert. First of all, the 2 and the 10 is what everybody talks about. I think it's the front end that really matters, because the way that I understand it, short-term rates reflect the cost for capital for banks. Long-term reflects what they lend it out at. So we get an inversion, there's a problem. But what we're seeing in inversion is at the 10-year and the 2-year, which is a little bit weird. Part of that is due to the fact that the Fed owns 25% of all of the outstanding treasuries, all of the treasuries that are owned by the Fed, and they've all been purchased. If we look at the Fed balance sheet, it's all, and 26% of what they own is all 1 year or less. And so it's having some impact to the yield curve. There's that side of it. But Waller brought up something else that we didn't hear. And that is that the yield curve is an average of the shorter term rates, and also a reflection of perception and changes, like you said, changes in inflation. That's what made me think about these two comments. I want to get the other one, but this one is, anchoring long-term inflation. And that if you're seeing an inverted yield curve, one of the explanations can be that we expect inflation to go down in the future, which is not a narrative that people are sharing. But I wanted to share it because it's part of the thinking that's coming from the Fed.
Yeah, that's actually a good thing, that the future expectation is we're going to see inflation lower.
And he said there's two reasons why the yield curve can invert. One is that we expect GDP to decline. The other is we expect inflation to go down. And how much of each is it? Certainly with inflation at 9%, 10%, probably pretty good argument that it's going to go down. Maybe GDP is going to go down too, but it's probably more due to inflation.
Yeah.
I do think there's one other person. We have to give credit to David Kotok, who really is, one of the people that pulls this all together. David he's got a force about him like gravity or a magnetism. He pulls together some of the best people in the world, and he thinks at a completely different level. He's a fantastic guy. He did have a presentation about long COVID that was worth listening to. He's sponsoring some research to help address this thing that happens. ME is the abbreviation. I forget exactly the name of it, but he was there with Emily Taylor, who's vice president for advocacy and engagement of Solve ME, which is ME is the name for what people who have long COVID get. It's also there's other diseases that are getting out there. So I just wanted to throw some hat tip to David for help moving the needle to address this problem, which could have a significant economic impact, by the way. If we some of these productivity issues could be related in part.
Yeah, a lot of people were pointing to, in fact, one of the next guests on the panel, Bill Kennedy. Sorry, no, it wasn't Bill Kennedy. It's the very next guest. It was Ellen Zentner, the chief economist at Morgan Stanley. She mentioned the labor force participation rate, and how the labor force participation rate is still, it's not back to where it was pre-COVID. And to David Kotok's point, and what you were mentioning with long COVID, is that's one of the reasons they're actually measuring the number of people who are falling into the disabled category right now because of their complications from COVID that are causing them to not be able to re-enter the workforce. And so, that's going to be a drag on productivity going forward as we deal with this disease, or the continuation, I should say, of this disease that we've been battling, this pandemic we've been battling for the last couple of years. Ellen's presentation was fascinating to me. I loved how she talked in the financial market being cycles. This goes, and we all know that, right? You get the boom, you get the bust, you get euphoria up here, you get fear down here, and it just naturally, the economy and the markets, they move in cycles. We've studied that for years. We try to point it inside of OptionsANIMal as we teach our clients how to navigate those cycles. But one of the things she pointed out is what happened with the Fed. When the Fed stepped in, we were already on the downward slope of a cycle pre-COVID. And then we had the COVID shock that sent us straight down. And then the Federal Reserve stepped in and caused us to have a V recovery straight back up. And what that did is that it put us right back into late cycle. So even though we had this recession, we had all this recovery policy, we were still in the normal late cycle of the normal economic cycle. And that's why we're dealing with this inflation problem right now. That's why we have this labor problem right now. And she feels like that just the natural cycle was we're heading into recession. That it has nothing to do with Fed policy, but we're just in the normal already in the late cycle of the market cycle that we've been in, and that most recessions do get preceded by inflation, and that's what she feels we're doing right now. Is these inflationary pressures that we're feeling are preceding a recession that we're about to go into. She didn't come out and say that we were in it yet, like John Sylvia did earlier, but she did feel like that it's very likely that the U.S. is headed into recession.
Well,
do you have any thoughts from Ellen?
No, she's definitely very bright. She's the chief economist at Morgan Stanley. So, yeah, she's a good speaker. And that was a good panel. You mentioned Bill Kennedy, by the way. He's chief investment officer for Risk Bridge. If we're dropping names of people who we're referencing.
One thing I like about Bill and, his view on the market, he's much more option centric. He understands the importance of volatility and big picture issues. I like that he threw out that the entire volatility complex right now is still pointing to uncertainty, and that the only certainty right now is uncertainty. And until we get the VIX back below 20, that you can still expect the markets to be chaos. And we're seeing that again this week, right? We had we had this huge bounce back up the last few days. Market was up 700 a couple days ago. The Dow was followed through yesterday and the day before. Now we're giving it back today because Snap. Really? Is Snap really that important?
Yeah.
Do you use Snapchat?
There's a couple people that's the way we communicate. And
that's the way you communicate.
I send dog videos to my
nice.
To my daughter.
I don't even have Snap, but my son loves it. My oldest son, I shouldn't say he loves it. He likes the Xbox a lot more than he likes Snapchat. The Xbox and Discord.
My son got that. There's a new game, video game of a cat that lives in a dystopian future, which my son loves dystopian futures and he loves cats. He sent me a video last night. So it's this cat that's trying to post-apocalyptic world, and this cat's trying to survive, and you role play as the cat. And I when I heard about this game coming out, I said, this is the absolute perfect game for you. And he said, yep. And he sent me a video of him and his cat yesterday watching this.
Nice.
Maybe I'll show it on should I do this? let me show you. Oh, I don't know. It's not going to work.
Post-apocalyptic cat.
So
awesome.
Here's the video game. Moving the camera. And
okay.
That's his cat. Watching him play a cat on his. I think that's PS. No, I don't know what the game's called, but his cat loves it and watches while he plays with the cat.
Well, I'm excited to kick this project off, Eric. I think this is going to be something that you and I can do, and be able to talk through the markets, talk through some of the confusion that's going on, and share cat videos.
Yeah, so there we go. I just shared a cat video. Let's make this all about. So maybe we end with a cat video every time. No, don't forget to like and subscribe. As they say in all YouTube videos, don't forget to like and subscribe wherever that corner is. And check us out you can get me on traderoasis.com and Greg at OptionsANIMal.com.
Yeah, I'm not wearing any OptionsANIMal gear today.
And go ahead, throw some comments down below on anything that you want more details on or think we should go deeper on or other topics. Holy crap, we went a long time today.
We had a lot of stuff.
We had a lot of stuff. So anyways, give us some feedback and let us know what you think.
Okay. Thanks, guys.
Catch you next time.